What if the next big trade isn't about finding the hottest stock to buy, but about identifying the ones that are most likely to fall? I think that's exactly what Benjamin P. is getting at with his suggestion to target shorts in semiconductors and memory stocks. Here's why that matters. If you can accurately predict which stocks are due for a downturn, you can potentially make a killing by shorting them. But there's a catch. It's not as simple as just picking a stock and hoping it falls. You need to have a deep understanding of the market, the industry, and the specific company you're looking at. Now consider the current state of the market. The VIX is sitting at 16.1, which is relatively low, indicating that investors are feeling pretty calm. But at the same time, the Fed is being super hawkish with no rate cut expected anytime soon. That's a recipe for potential volatility, and it's exactly the kind of environment where a well-placed short could really pay off. Take the semiconductors, for example. The SOXX index, which tracks the performance of semiconductor stocks, has been on a tear lately. But if you look closer, you'll see that some of the bigger players in the industry, like Micron and Western Digital, are starting to show some weakness. Their stocks have been falling, and if that trend continues, it could spell trouble for the rest of the industry. Which brings us to the memory stocks. These are the companies that produce the memory chips that are used in everything from smartphones to laptops. They're a crucial part of the tech industry, but they're also highly susceptible to changes in demand. And right now, demand is looking a little soft. Oil prices, for example, have been falling, which could indicate a slowdown in the global economy. And if that happens, it's likely to hit the memory stocks hard. Take a stock like Micron, for example. Their stock price has been volatile lately, but if you look at the charts, you'll see that it's been trending downward. If that trend continues, it could be a good opportunity to short the stock. But here's the thing, shorting a stock is not a decision to be taken lightly. It's a high-risk, high-reward strategy that requires a deep understanding of the market and the company you're looking at. And even then, things don't always go as planned. So you have to be careful, you have to be disciplined, and you have to be willing to adapt quickly. Now, I know some people might say, but what about the potential for a short squeeze? And that's a valid concern. A short squeeze is when a stock that's being heavily shorted suddenly surges, causing the shorts to scramble to cover their positions. It's a real risk, and it's something you need to be aware of. And that's exactly the problem. There are so many factors at play in the market, and it's hard to predict what's going to happen next. But that's also what makes it so exciting. If you can navigate the risks and come out on top, the rewards can be huge. So, let's have a real debate about this. On the one hand, you have the bears who are saying that the semiconductors and memory stocks are due for a fall. They point to the weak demand, the high valuations, and the potential for a recession. On the other hand, you have the bulls who are saying that these stocks are still strong, that they have a solid track record, and that they're poised for future growth. But if I had to weigh in, I'd say that the bears have a stronger case. The data just isn't looking good for these stocks, and I think it's only a matter of time before they start to fall. So what does this mean for your money? Well, if you're looking to get in on the action, you could consider shorting some of the weaker semiconductor and memory stocks. But you have to be careful, you have to be disciplined, and you have to be willing to adapt quickly. You could also consider looking at some of the ETFs that track the performance of these industries, like the SOXX or the USO. These can give you a more diversified exposure to the sector, and they can be a good way to hedge your bets. For example, you could buy a put option on the SPY, which would give you the right to sell the ETF at a certain price. If the market falls, you could exercise the option and sell the ETF at the higher price, pocketing the difference. Or you could buy a call option on the USO, which would give you the right to buy the ETF at a certain price. If the market rises, you could exercise the option and buy the ETF at the lower price, then sell it at the higher market price. In the end, it all comes down to how you choose to play it. If you're feeling bearish, you could short some of the weaker stocks. If you're feeling bullish, you could buy some of the stronger ones. But either way, you have to be aware of the risks, and you have to be willing to adapt quickly. That's just the way the market works. So, If you want to stay ahead of the curve, if you want to be one of the first to know when the market is about to make a move, then you need to be watching the semiconductors and memory stocks closely. And if you want to see how we're playing it, if you want to see our actual moves in real time, then you need to join us in our Discord. We're always discussing the latest developments, always sharing our insights, and always looking for ways to stay ahead of the game. Educational only, not financial advice.